Hey, everybody. Welcome. It's, I think, week 66, if I'm not mistaken. 1776. So this is Flag Week. Flag Day was Monday. I'm just curious, Jack, do you know the origins of Flag Day
I do
without
not.
Googling it?
I
So
do not, but
I'll share it with you. This is kind of
please
cool.
do. Yeah.
So June 14, Monday, but it was June 14, 1777. The rebels, Patriots, actually finally got rid of the Union Jack flag and what became the Betsy Ross flag of 13 stars. North Carolina, one of those. That became the official flag of these United States. What became the United States. So anyway,
Excellent.
I thought it was kind of cool.
Yes, thank you for that. I'm sure my kids probably knew that. I'm ashamed that I don't. So thank you.
Well, it's rare that I know one little tidbit of trivia that you don't. So I'll just bask in the glory for right now. So, hey, everybody, as you're ramping on, we want this to be a dialogue. We really want to have live Q&A, especially as we go into, hey, corporate structures, they vary, they have advantages, they have disadvantages, and they have times in your life of the company that it may make sense to switch horses and make those changes, but those come without, you better have some good counsel by you whenever you're making those changes, or especially if you're starting one. So that's what we've got today with Jack Santaniello of Shoemaker Law, great M&A attorney, great expertise in franchises as well. And then we've got Matt Andersen, the Adam Boatsman stunt double, and he is excellent. And it is not that he's in Adam's shadow at all. They are both really powerful people. And Adam is, enjoying Greek life right now. He is not in the fraternity, but in the country. So we're going to let him have a much needed respite. And so I'm going to go ahead and so if you would, you can still harass us in the chat. We'll still take that. We do want it to be interactive, but these guys have got a little, some show and tell slides to talk about, to give you guys some visual explainers, if you will, of various structures and why this or that. So Jack, I'm going to go ahead and make you the host. And now you can go ahead and share your screen and take it away.
Okay, let's see. I want to make sure that I share the right screen and not scare anybody. So I probably, let's see, let's do this one.
Yeah, don't put up the dad joke screen.
Oh yeah, okay, good.
It'll spoil all the punchline.
Yes, definitely. So can you guys see that? It's the cover slide? No?
We do not see it yet.
Okay. Technical difficulties. Let's see.
So while you're doing that, Matt, show your subliminally overt background, but you got to talk.
All right. Hey guys, coming live from BGW, and you can see the background. Big shoes to fill of the Adam Boatsman while he is out, and looking forward to having some fun and getting some dialogue from everybody. But here's the background, burning bright and orange. Go. And Jack's on.
Good job. You're doing the stall technique really, really well. So
yeah, thank you for
you're
that.
A keeper.
Yeah, definitely. All right. So to just be transparent, I've had the opportunity, as have BGW, to do these type of presentations. I do it for lawyers, chambers of commerce, other business owners, et cetera. So this is kind of an extraction of a much larger presentation. But what we want to talk about, as you said, is the choice of focusing on choice of entity, but also some basic nomenclature, kind of taking a step back a little bit, but in anticipation of not obviously not that you're forming a new entity from the get-go, but this is maybe in a merger and acquisition transaction, or maybe a transformation, or maybe you're going from a sole proprietorship to a partnership via an LLC or some other vehicle. So, why would you choose S Corp tax status when you're an LLC and those kind of things? So that's what we just wanted to go through. And so Matt and I are just going to kind of tag team back and forth like Adam and I usually do, but we have some screens to be able to do that. So this is, the way when I do these presentations, it's like, okay, this is kind of stating the obvious as to what the stages of the businesses are. But what I thought, I put this up here because it's an interesting graphic to show that there are plateaus. It isn't like a constant stream going, I guess, in that direction, right? As I'm opposite, but that there are these ebbs and flows of various places in time, and then there is something that is a trigger, whether it's a loan, whether it's a exit strategy, succession planning, whatever it may be. So share that. So in talking about corporate formation, in my mind, there's kind of three categories. And, so sole proprietorships are what they are, and we'll talk about them. But then you have this bucket, which is the corporations, and, obviously S corporations are in there. And then under partnerships, you have all of these things that mean certain things, which is, for example, PLLC, you have to be a licensed professional like medical, and then they get certain protections based on their licensure and their abilities and their responsibilities for that license. And so they get certain protections. But really, obviously, the two things that we focus on and talk about most often is the S corporation and limited liability company, and LLCs that make an election to choose the S corporation. So a little bit of nomenclature, and this gets confusing all the time. So I go through it, obviously, and you've seen all this stuff before, but it's kind of like, what is the interaction? What is the translation matrix between all of them? So you have shareholders and directors in a corporation, and so you have members and managers. A lot of times the term manager is misconstrued, meaning like a general manager. A manager is at the level of a director in a corporate structure. You form it by articles of incorporation, they change the name to organization. You have bylaws and shareholders agreement. So the generic and the specific, which are then combined in the LLC world into an operating agreement. So in making the choice of entity, I'm just going to go through a couple of things, and Matt, stop me at any point if you want to make any points or jump in. But just general partnerships, two or more people carrying on as co-owners. Here's something that people don't necessarily understand. If you use the term and you go out there and you say, "This is my business partner," you may have just created a legal partnership. You do not need to have a document that says that you guys are a partner. And so the problem is, or the challenge is that you've just put yourself in a situation where that person makes a business decision. You may be personally liable for that bonehead thing that was done, or even if it was innocent, but you're responsible for the consequences of your business partner's behavior or actions or inactions. So including wrongful acts. And I'm going through this kind of quickly because I want to get to the LLC and the S corporations, but I want you to kind of understand these other things. So limited partnerships is generally you have one general partner and you have limited partners. The intention is that the limited partners are passive investors in most cases. They give money to get reports back, but they are not involved in the management decisions of the entity. And we don't see a whole lot of those necessarily because, and we'll talk about why the LLC is usually the champion of choice and necessarily. So sole proprietorships. So we'll talk about advantages and disadvantages of some of this stuff. So you have these things, well, it's just you. So it's a pass through. It's simple to set up because there really is no setup. There's no stake filing required. And as I said, easier to manage because it's only one person. Disadvantages is that it's directly personal liability. You don't have this thing, this legal being person that is a barrier to someone reaching your personal assets, except under certain circumstances. You do stupid things, you're going to be personally liable. Things like harassment or discrimination. You sign up for it. So you sign a bank loan guarantee, you sign a franchise guarantee, you sign a lease guarantee, or you sign my engagement letter, which we'll be signing personally if you sign up with us, because I know where your stuff is and it's not necessarily with the LLC. Insurance helps, and then there's self-employment tax issues that you have to deal with in all of them, but particularly there. And then it's one owner. So once you have more than one owner, then you're not sole proprietorship anymore. So it doesn't allow for multiple owners. And as I said, this is a choice by default if it's just one owner and no formal choice is made.
And Jack, can I jump in from the tax perspective?
Yeah.
So just to echo with what Jack was saying, sole proprietorships are relatively easy to manage from a tax perspective. Basically, there's an additional schedule that goes on the individual tax return, and that is how you pay taxes basically on the net income of the sole proprietorship. One thing that Jack's got in there, the disadvantages, and I want to elaborate a little bit on, is the self-employment tax. As a sole proprietorship, you pay taxes on the net income. So you pay federal and state income taxes on the net income, but a sole proprietor is also responsible for covering self-employment tax, which is basically the Medicare and Social Security, but partly for the employee and partly for the employer. And the total amount of that tax is about 15%. So when you're looking at a sole proprietorship, if the blended federal rate's 25%, 5% to the state, you're looking at about 30% in federal and state income taxes. Plus we have to layer in the 15.3% for the self-employment tax. So potentially with sole proprietorships, you're looking at 40 some odd percent, highest rate that you could be paying on it. So one of the big disadvantages, but again, on the easy side, they're very easy to set up, very easy to administer from an accounting perspective.
Hey guys, while we have a little pause, we've got a couple questions that have to do with S Corps and one with an S Corp acquiring a C Corp. So we want to get to that, but there is one question in here about, and here, let me read it to you. I'm an individual that's interested in buying a rental property for passive income. The goal is to have two properties. Should I open an LLC for that or keep it in my personal name?
Well, the legal answer is yes, it should be in a separate entity, because what you're doing is you don't want, let's say as a landlord, I assume you're going to lease it out, and you want to protect your personal assets from business liabilities. So you get sued. You want there to be a barrier between those two things. And so, yes, now there are challenges in doing that, in that, okay, if you can't, in theory, get a residential loan for buying a commercial property. So what are you going to tell the bank, honestly or not honestly, about what the purpose of the loan is? And then also, who's going to take title to that property? Is it the LLC? Is it the individual? And then obviously, if it's the LLC, then you're going to end up with a personal guarantee with your lender for that loan. So those are just some considerations to think about.
And I think we'll look a little bit more into this as well, looking at the partnership versus just operating as a single owner LLC. To keep it from a simplicity perspective, from a tax perspective, just being a single owner of the LLC, it just goes on your individual return. But what Jack was saying will give you some of that asset protection.
All right, next question I want to address. I'll actually read both of them, and I know we'll get to Joe's here in a little bit, but here's the question. As an S Corp in the service industry, we're interested in buying a commercial property to stay there instead of renting space. Should we start a new entity to separate it from the main business? The idea is to isolate that investment in time of litigation. Your thoughts?
Yeah, I think it's kind of the same, which is that, keep it separate. Don't want to speak for you guys, but as far as accounting, it's if it's all passed through and ends up at the same place, which is in the individual's pocket, but for liability purposes, you do, just conceptually, in most cases, you want to keep your business liabilities away from your personal assets. And said another way is, you don't want your personal assets to be the collateral for the business, good or bad, unless you're forced to do that, obviously. So yes, you want to do that. And a lot of times, if it's the same business, like we've all had clients who have bought real estate and lease it back. to their operating company for fair market value. And so that there's a landlord-tenant relationship, and it's you keep those lines separate, and then you can and sometimes, let's say you sell your business, you may not want to sell the building that it's in, so you end up with additional income post closing that you're now the landlord for the successor operator of that business that you had been operating for 25 years and now sold to someone else because they didn't buy the real estate associated with it.
Good answer. There is a little quick follow-on question from the first one. Can I buy an umbrella policy for each property instead of starting an LLC?
I would say, well, yes, that's a possibility. I mean, you can insure however you want to in most cases, but the policy is to fund issues to begin with, and so you're still, if you have multiple properties, you are allowing the multiple properties, the equity value, to essentially be collateral for issues that arise at another property. And I would also say, just generally speaking, and again, I'll say this as I normally do, but now since we're kind of going deeper into legal advice, that obviously it depends on your circumstances. So this is just friendly discussion amongst us, right?
He is a lawyer.
Yeah, exactly. Generally speaking, you just need to keep things separate, just because it is the best way to keep those liabilities separate. But you can get the insurance for that. I mean, I assume that insurance companies, and I know that they will insure whatever you want them to insure. But here's the thought I lost for just a second, which is that a lot of times the analysis as to whether or not you put everything in one bucket and one LLC is the closeness or the disparity of risk as between the businesses or the assets. So if you own let's say a temporary placement company, and you go into the 18-wheeler industry of drivers, that is a whole different ballgame. Yes, you are putting temporary workers into the workplace, but are you going to give them put them in a multi-ton vehicle, or are you going to put them in a warehouse doing something? So it's those kind of things that you need to assess the relative risk between the assets and the operations, and that should be a major factor into whether or not you're going to dump it all into one. And it could be that you put 9 out of 10 things into one, and then that 10th thing, business line, assets, liabilities, are just different. So you're going to keep that separate and apart.
Makes sense. And then the last question, just to think about as we go forward, is from Joe. Good to see you here, Joe. Later on in the discussion, can you speak to an S Corp acquiring a C Corp and what to look out for?
Yes, that is a tax question, because the legal issue is, sure, we can write all kinds of papers to make that happen. So that's a Matt question as far, because really what you're asking is what are the tax consequences, tax penalties, potential issues is really what I suspect. So
yeah, and I would just say, if we could get, I think, a little bit more information, because an S Corp can acquire the stock of a C corporation. The C corporation still continues to operate and pay its own income taxes. So, is it a full acquisition, or I think is the question, do you want to roll it up under the S corporation? I think a little bit more information would help.
Yep. All right, cool. Let's keep rocking.
All right. So general partnerships, don't do it. Because it's just a lot of liability. I mean, this is like an open checkbook, but there are advantages. It's pass through, it's simple administration, single level of taxation, essentially. Obviously you can have more than one person, not put in there, you can take vacations and not, if you trust your partner, and you can put different allocations of profit losses in relation to the ownership, which you can't not do in an S Corp. So disadvantages, personal liability is joint and several. So as we said before, it's like the other person does something stupid, you have no idea it happened. Because you're a partnership, you're going to be responsible for that potentially personally. So again, putting your personal assets at risk. It's not a boss of one, it's a boss of several. So hopefully you get along with the person, but if not, that can create problems. Self-employment tax issues, and there are complex partnership rules, statutes, mostly Treasury regulations that govern the relationship between the partners with respect to tax issues. So, and as I said before, you have two or more people in a relationship, and they don't choose an entity form, this is the default. So,
and I'll jump into Jack here. With partnerships, I mean, it's in essence the second level of type of entity from a tax perspective. A general part or a partnership can include several different entity types, an LLC, a general partnership, LP. But looking at it from a tax perspective, again, going through reiterating what Jack said, relatively easy or easier to get set up, especially if there's multiple people to be involved. One of the catches, again, with basic partnership is the self-employment tax. And I keep hammering this, but as we get to the corporation, there'll be an explanation as to why. But looking at a partnership, again, they're responsible for self-employment tax, very similar to what a sole proprietorship is. There are some ways to work around it, but in general terms, that each partner is going to be subject to that self-employment tax. So if we're looking at it from a tax planning perspective, you still have the federal and state income taxes, but then layering in that 15.3%, it can be a little bit more costly. But partnerships do work. Again, if for the right situation, they can be they are ideal. But again, we'll explore a little bit more when we get into the corporation side on the self-employment tax.
all right. Limited partnerships, not really too much to say other than, the limited partners, so long as they don't participate in the business, generally have limited liability. Again, pass through. General partners call the shots, so it's not, you're not necessarily running a business. And the general partners still have the power, so that's kind of an advantage and a disadvantage. General partners have unlimited liability, but, as kind of Matt alluded to, there's various forms and formations that you can use to layer the corporation, have the general partner be an actual corporation or other entity. You do have to file a formal filing to become a limited partnership, and it dissolves upon death of the general partner with some exceptions. And so usually a partnership agreement will have what happens in the event of a general partner leaving, because they're the ones that have the unlimited open checkbook. And then, as we talked about, limited partners, and then since for a couple of decades now, this is more of a practical, not a legal requirement in the state of North Carolina, but most limited partnerships are not given a whole lot of power anyway. So,
hey, while we're on this subject, I want to read this question that came in from Bob. Good to see you here, Bob. It says, I've got multiple LLCs that are real estate companies, one LLC for each building. However, the oldest building / company is a general partnership before LLCs existed. Should I change it to an LLC? Would the pass-through income be the same either way, and the only difference be paying North Carolina $200 per year?
I'll let Matt answer that, but I think the answer is yes. But it depends on if it's run as a general partnership. You do have that line between the two, so there is some advantages in becoming an LLC as an owner. But then you have issues if what does the deed say? You have to transfer the deed, title policies, and everything else. So if there's not a whole lot of risk in remaining as a general partner, then you might want to consider staying as a general partner from a legal perspective. But that may not be the right CPA response. So I don't know if Matt wants to jump in on that, or we can cover that later on. So
Yeah.
I'm reading through it. Let me digest it. I'll hit it here in a minute.
Okay.
All right, cool.
All right, C corporations, limited liability, ownership is easily transferred. You have stock, well, in theory, depending, the shareholder agreement restrictions. You can have multiple layers of stock, preferred shares, non-preferred shares that have different economic as well as power within the entity. Usually, when you have a larger ownership pool, that's when you typically use C corporation, because you become closer to potentially a public entity so consider those things. Multiple jurisdictions, it's easier kind of to operate in multiple jurisdictions potentially. And like I said, public companies, or if you plan to go public, that usually is that form is easier to get through regulatory process. And also, if you have, and I put tax-free, that is not in every instance, but if you have a reorganization on the horizon, that may be an option for you. Disadvantage, double layer taxation. So you get taxed at money comes in, it gets taxed as income, and then if you distribute to the owners, it gets taxed at their rate as well. So that's why we talk about double layer of taxation. Conversion to an S corp may be problematic. It depends on the tax basis and other issues, as far as is it more of a liquidation and a recontribution of assets that now have a stepped up basis, but you have to pay taxes, or is it truly a tax-free transition? So tax on excess retained earnings, state filings required, and then other ongoing formalities that you have also in the S corp, but annual reports and filing fees. So I think, and then piercing the corporate veil, which is a topic for another day, as far as, yes, you do have this protection. Again, as we're talking about personal assets and corporate company liabilities, but you can either inadvertently or purposefully break down that wall between the two based on your actions and inactions in certain circumstances. Tough to do, but not impossible, and not obviously unheard of, because it happens. So,
hey, let me jump in and ask another question. So David has a question with regards to LLC. So they've got a real estate LLC partnership with his wife. They file jointly. Is this partnership a disregarded entity? Are there any instances when a company with multiple owners is disregarded for tax purposes?
With multiple owners, there's not. So with an LLC, if it's a single owner, it can be a sole proprietorship. But if there's multiple owners, the LLC would need to file a partnership tax return.
All right. Hopefully that helps, David. All right, keep rocking.
All right, S corporations, which is, we're getting closer to what you guys really want to talk about, right? Everyone wants limited liability, pass-throughs, no self-employment, payroll tax on profits, distribution to shareholders, which Matt will, I think, expand upon. So I didn't say no tax. I said no self-employment tax on distributions. It's very key, right? Easily multiple jurisdictions. You can use stock options. And this is related to the shareholders can be employees, so it's W-2 wage earners, and then that same person can also be an owner and receive distributions. So that's one of the advantages of, and maybe even the core advantage of being an S corporation in some people's minds. Excuse me. No limitation on shareholders, limitation on who can be shareholders. There are some exceptions where you have trusts, but it's usually an individual. It has to be the actual owner of the S corporation. There's limitations on employee benefits, such as like Section 125 plans, and you can only have one type of stock. You can, meaning the power, the equity, the distributions with the shares. You can have voting and non-voting, but if you have 25, 25, 25, 25. At the end of the day, you got $1 left over. Everybody's getting a quarter. You cannot say, well, he did more, so he deserves 50 cents out of $1. So you can't modify that in an S corporation. but you can modify the voting. Sorry, I didn't mean to go too far, Matt. If you had comments on the S corp, or if you just want to get through, go ahead.
Yeah. So what I'll do is I want to back up a little bit to the C corporation and run through a little bit of the tax implications of the C corp, and then we'll look at the S corp. With the C corporation, one of the pros is that they're, from a tax perspective, very easy, or they're better suited to build capital. And why I say that is right now the highest corporate tax rate is 21% versus 37% for the individual. So the C corporation will allow you to build capital a lot quicker at a lower tax rate. But to what Jack pointed out, is one of the drawbacks is that if the company distributes a dividend to the shareholders, that dividend then is in turn taxed at the individual rate. And depending on where they're at, that can be 20 to 24% just on the federal side. So it ends up being a lot more expensive if the corporation is going to build up the capital and then distribute. Again, C corporations work really well if you're trying to raise capital and go down that route. And it allows for a lot of different variations for equity. So C corporations fit, and it just really depends on what the purpose and intent is of the company. Switching gears here to the S corporation, Jack did allude that it is a flow-through entity. So what that means is the corporate tax return is prepared, and off of that corporate tax return, there's a K1, and that K1 will flow through to the individual's tax return. This is similar to what would be done in a partnership. The difference between a partnership and an S corporation is going to be the self-employment tax on net income. And usually what I like to do for a simple example for clients is $100,000. So let's assume $100,000 earned as a sole proprietorship, or as let's say it's a 50-50 partnership, a 50% ownership of a partnership's $100,000. The difference, so with a sole proprietorship or partnership, you're going to pay your federal and state income taxes. So let's say that's 30% blended. So that's the $30,000 of federal and state income taxes that you're going to be paying. But as a sole proprietorship or a partnership, you're going to be paying the self-employment tax. So you have to layer in another 15.3%, so around $15,000. So in that example, a partner, a 50% partner or a sole proprietor is going to be paying about $45,000 roughly in taxes. If we look at an S corporation, and an S corporation making $100,000 net, they will still be responsible for the federal and state income taxes of about $30,000, but there is no self-employment tax as of now on that earnings. What the IRS does is says that you're required to pay reasonable compensation for your activities participating in the S corporation. And this is how they get the FICA, the Social Security, and Medicare, but it gives you the flexibility to determine what is reasonable based on what you're doing, and control, in essence, the amount of FICA tax that you want to pay in. So in this example, let's assume that the shareholder decided that $50,000 was reasonable compensation for the services that they were doing for the company. That would end up costing around $7,000 in FICA tax. So in this example, you're, as an S corp, paying $30,000 of federal and state income taxes and about $7,000 of FICA. Whereas if we're in the partnership or sole proprietor realm, you're looking at about $45,000. So the difference saves you about $7,500 by being in the S corporation. Again, just be aware of the restrictions on the shareholders, the different classes of stock that Jack was mentioning. But the S corp is very popular due to this. And one last thing that I'll add is, with Biden's tax plan coming in, looking at a corporate tax rate moving from 21% potentially to 28%. And then also looking at the S corporation, there is some legislation or some ideas out there about making the earnings from an S corporation subject to self-employment tax. This has been being talked about for years, but it is just something that's potentially on the horizon that would eliminate some of that benefit of the S corp.
Hey guys, I want to do a quick pause for a couple questions that have come in specifically about S corp. So Jack, you anticipated this correctly, or you've seen this movie before, because there's a lot of activity around S corporations. So So this goes to you, Matt. Can you talk about the advantages of having an S Corp with tax return based on cash basis versus accrual basis?
Yeah. So the difference between cash basis and accrual basis in general terms is basically receivables and payables. Without being required to do it, most of the time, taxpayers are better off on the cash basis. And the reason I say that is if you've got $100,000 in open receivables and you are on the cash method of reporting your income taxes, you're going to pay taxes on $100,000 in which you do not have the cash. So I prefer and recommend, as long as you're allowed to do it, is to be on the cash basis for tax perspective, because those receivables won't be taxable until that cash is collected.
Cool. Another question, and this is a tax question. Can you describe further the tax impact of a C Corp converting to an S Corp?
Yes, it is a complex answer. What I will say is when you make the conversion, there will be potential assets that are sitting out there that may have to have C Corp taxes applied to it. I think it's a case-by-case scenario. For example, I've got a construction client that we work with that have a lot of open jobs, and they are a C Corp currently, and we've looked at potentially moving them to an S Corp, but they would have to recognize the gross profit on the jobs that they had currently earned at the C Corp rates, and that's just not something that we were willing to do from a timing perspective. So it does depend overall on the situation. Basically the earnings that are potential future earnings that the C Corp have, those would need to be accounted into when we're looking at the S Corp conversion.
And this may be a legal question, but I thought that there was some sort of a timeline that for some reason I had 3 years in my head that if you were one classification, you had to maintain that classification for a period of time before you could revert or change it. Am I accurate in that, or can you, either one of you guys, clarify that?
I think if you convert from an S to a C, I think you have to wait 5 years. So if you move from an S Corp to a C Corp, or you make the change, there's a 5-year waiting period for the IRS.
Okay. Yep. All right, cool. And then one other little point of clarification. So Robert Mayetta, good to see you here. Single member LLCs with no employees allow for the owner to have a solo 401k and shelter up to $58,000 per year, or $64,500 if age 50 or above, depending on sufficient revenue level of the LLC. The benefit of this may exceed the benefits of filing as an S Corp. Any comments on that?
I would agree. I mean, depending on the the tax rates that you're at, I would agree. So again, looking at S Corp versus sole proprietor, I think it does vary case by case. So you do want to look at the facts and circumstances of what you're at and what your objectives are. A lot of times we'll have folks that they have a W-2 job somewhere else and they're looking at starting a side business. Well, the difference is not 15.3%. It's the Medicare portion of the 2.9. So that does change the conversation. I think my example was pretty much in general terms. It's going to be case by case.
Yeah. Two more quick questions before we move to the next. So Matt, can you clarify that? And this goes back to David's question: is my LLC partnership with my wife a disregarded entity? And is there a better formation?
So the term disregarded entity is if it's an LLC that's basically being taxed as a sole proprietorship. With an LLC with two members, it's going to be a partnership return. And I think going back to David's previous question, I think it's going to be is it a real estate holding partner or real estate holding partnership in an LLC? And I think that's the best route to go in.
Yeah. Okay. And then finally, can an S Corp with cash accounting basis defer paying tax on deposits if the clients have open receivables?
And that again varies case by case, but a true cash basis taxpayer would pay taxes on deposits.
All right.
Thank you for answering that, because I wasn't going to touch that.
Well, you know what your lane is, so that's good. All right, keep rocking, gentlemen.
All right. I don't know. I paused it, and hopefully that brought full screen to you guys, but hopefully we're back on.
No. Okay.
No, it didn't?
Yeah, we're good.
Okay.
We're on limited liability companies.
All right. So, we've kind of talked about this in the reverse, but limited liability, it's not joint and several, pass through, easier to maintain corporate formalities. So I get this all the time, every year, is, wait a minute, why do I have to, as the shareholder, bless everything that the director did? Oh, I happen to be the sole director. And then I, as the director, have to bless everything that I did with respect to the officers. And so that's just stupid. I'm like, yes, it's stupid, but until they change the law, that's what you got to do. So you don't have to do that kind of paperwork on an annual basis. Flexibility in allocating income. So as we talked about with the S Corp, there's limitations on allocation of net income on the ownership level if it's an S Corporation. So assuming that this LLC does not choose S Corp tax election, then the default is that you can say, even though I'm a 50% owner, I'm going to get 80% of the net income at the end of the day as a distribution to me as an owner. Member or manager managed, that goes into legal issues as to who is going to be operating. But what that means is that you can have members that are not managers. So you can have owners, shareholders that are not directors, which makes sense. Disadvantages, self-employment tax for active members, developing case law. This is kind of an older slide, but I would say that imagine that corporate interpretation in case law in the courts has a much more lengthy history than interpretation of LLC law. But what happens in that instance is you have corporate type laws applied to or interpretation applied to LLCs, except for the fact that, and I have the benefit of one of my partners who rewrote the North Carolina LLC Act. He won't tell you that, but he was the chair of the committee several years ago. And of course, the chair of committees do all the work. And so he was responsible. And his response when I go to him and say, can this be done within the LLC? And he says, what does the operating agreement say? Because his perspective is that if it is not illegal or against public policy, if the operating agreement says you shall wear a yellow tie every third Tuesday of the month, and if you don't, you lose your membership interest, that's enforceable.
Wow.
Now, there are issues of fiduciary duty if it's the minority that you are taking their 20% interest away. But the theory is that it's a contract and you are bound by that contract. So don't come to the court to complain that, well, I didn't realize being in a 50-50 relationship means that we could be at a deadlock. And to resolve that deadlock may mean many tens of thousands of dollars in litigation and accusations and destruction of that business. So be mindful of that. Partnership tax rules, unless you choose to be the tax election for a C corporation or S corporation. And usually you have an informational tax return, even though it's a pass-through. Single member LLCs are allowed, and it's taxed as sole proprietorship. So Matt, if you want to add some commentary to that.
Yeah, and I'm glad that we went through the structure kind of the way that we did. So we started with the sole proprietor, went to the partnership, went to the corporate structure. I'm going to have a question for you, Jack, at the end of this. But the LLC is, from a tax perspective, is the chameleon. And LLC can be pretty much taxed at any of these levels that we decided. So sole proprietorship, a partnership, a C corp, or an S corporation. The LLC gets to make that decision. So I think one of the questions that I run into a lot, Jack, is why would I choose in the corporate structure, if I wanted the LLC to be taxed as a corporation, whether it's an S corporation or a C, why would I want to choose an LLC over an Inc?
So it's actually up on the screen. It's the flexibility, but well, that's a tax issue really, but it's easier to maintain corporate formalities. And it is, as I said, that, so actually it's a great question and a little bit complex, but I'm going to give you the Cliff Notes version of it. Is that in comparison to if you were to take the North Carolina LLC Act and put it next to the North Carolina Corporations Act, you would see that the Corp Act is much thicker than the LLC Act. And the reason is that the corporations laws are meant to be not filler or backstop. They are meant to be, these are the things that you do unless you say otherwise in the agreement. The rules for an operating agreement for an LLC are more gap fillers. So if you didn't happen to mention this in the operating agreement, so if you were to look at an operating agreement, it's obviously going to be much thicker because, as I showed in the slide before, it's a combination of the bylaws. This is what this person does. This is how we're going to manage it. This is how we're going to do the other things. But it also has the shareholders agreement components, which is what happens with successors. What happens if an owner gets an offer they can't refuse? Well, you want the company and the other owners to have rights of first refusal. So those are the same as between the two, but it's really the ability to be able, more freedom of contract with in the LLC environment. So as you said, some of these things on here, I'm making assumptions that not S corp elections and things like that, but so and also that the member and manager manage. In both cases, you can assign duties to officers, or you can call them whatever you want. I don't do this as often, but I usually have officers in an operating agreement, which is, you will not find the term officers in the LLC Act. They talk about more like delegates of duties and authority, but a lot of times people know, or they assume, that a president of a company, when you hand them a business card, has some authority, a vice president of sales, vice president or whatever. But when you say, hey, I'm the manager, even with a capital M, they have no idea what that means necessarily, or they assume that there is not as much power wielded by that person. So they're thinking, I thank you, but
Yeah, we lost audio here. Jack.
Yeah, how about now?
All right, we're back.
Okay, I ran out of battery on the left pod. Okay, I don't know. Does that mean I'm talking too much or too long?
You just got bleeped out.
Okay, all right. I don't know if we want to go into corporate governance necessarily, but I just want to share a few things that, as far as liability of owners. Okay, and the purpose of setting these entities up is to shield as I said, the owner's assets from the company liabilities. And so the way you do this, obviously, is in the governing documents. Well, you file with the Secretary of State, and then you put together the governance and operating documents. So whether it's the operating agreement in the LLC or the bylaws and shareholders agreement in a corporation. So that is your intention in doing that. And it happens all the time. It's like you just start going and you have bylaws, but you don't think about, well, the what ifs. A quick kind of war story is representing a bar owner, a restaurant owner here in town, and he had investors who were mature adults, but two of those investors, their beneficiaries were some 21-year-old kids, one of their kids. And guess who decided that they thought, well, I'm an owner, I can do whatever I want. I'm going to bring all my fraternity brothers and sorority sisters into the bar and just go drink for free. That happened like once or twice. And then I got the phone call and I'm like, no. And so those are the things that you need to think about as to, down the road, that a lot of times, it's just, why think about that? Because that's just down the road. But, so, and we've talked about, directors and managers, but you have general standards of conduct, good faith, ordinary care, reasoning to believe in the best interest of the corporation, so no self-interest. And a key issue is that one of the key issues in making the decisions is that you can rely on what other people tell you. So if Gary and Matt say something, and they in the form of an opinion, then you can rely upon that and say, well, my CPA told me this, my lawyer told me this. So that's why I would say that when you need a formal legal opinion from either of us, it tends to be somewhat expensive. And I'll tell you why. No one else will tell you this, but I'm telling you why, is because we are giving you a piece of our malpractice liability insurance policy for the fact that if whatever reason we kind of screwed up, we have to pay for it. So that's why those things tend to be somewhat expensive. But I didn't say that, and don't tell anybody that I said that.
And that is why these are insights, not necessarily legal or tax advice on these free webinars.
Right. That's right. Okay. And then obviously, I guess, if it's incorrect, you can't say, well, just because it's on a piece of paper that my lawyer or my CPA gave me, well, surely, but it just is an obvious error, then you can't rely upon that. That's just, you're not going to get the benefit of that. Okay, we talked about actual reliance, and then if you do things you're supposed to, and then there's the business judgment rule, which basically says is that it may have been a stupid idea, it may have not resulted in the result that I wanted to result in, but it was within my judgment call. So you may have made a different decision, but I made a decision. It isn't fraudulent. It isn't a violation of my fiduciary duties. So we just got to roll with it, essentially. So that's, if you hear that term, that's what that means. Officers, basically the same. So same standards of good faith, fair dealing, etc. Reliance, same as directors. And also, if it's totally unbelievable, stupid, like, you can't rely upon that stuff. And I'm going to stop there and see, or Matt, if you want to add, or Gary want to add anything to duties of officers and directors, or anything along those lines. Or answer any other questions.
Do the right thing. That was one of our core values at Bank of America. And I really like that. You could have 10 feet thick of legal documents, but go back to the question of, is this the right thing to do? And you might be able to solve all that paper. I do have this question that just came in that I want to address, if you guys are willing to do it. Michael says, hey, can you speak to the transition of an S Corp to existing employees in the way of a stock sale? If two employees involved, should we have separate LLCs or create a combined LLC to purchase the S Corp? Assume LLC would provide more personal liability protection.
Okay, so I'll make sure I understand. We're talking from the employee's perspective, that as far as an exit strategy or transition, those employees are going to purchase the current owner's business, their equity. And so in that instance, yes, I mean, it would be beneficial to, protect yourself from liabilities. It creates one extra layer. So, let's say that the other employee does something on the ownership level, or just something in general, for them to come after you personally, and you weren't involved in that decision, then they would have to pierce the corporate veil, which is to get to your personal assets. So it's just one extra layer. Now, the reality is that when my litigators find out that there's multiple layers, they just throw everybody in the kitchen sink. And they're like, we'll figure it out later, but we know that there are these 3 LLCs. Who are the owners? So you have multiple defendants in that, and then you sort it out, and then you have to basically say, well, you don't have a claim against me personally. I didn't sign a personal guarantee on anything. I didn't do anything personally, so I'm just not responsible for that. And then you get into that. So It does, but there's at least with an LLC, you got to pay your $200, 225, I think it is now every year, and file a piece of paper every year for the privilege of having that. But some people, 225 to give me a little bit of extra protection. Yeah, would love to do that. Another just totally tangential issue is, check your liability policy, check your umbrella policies and see if those umbrella policies that you probably purchased as additional for your homeowner's insurance or your car insurance, especially when you have teenage drivers, then it may cover business liabilities as well. And so, or you may be able to get a rider associated with that. Now, I'm speaking out of turn. I'm obviously not an insurance agent, but I know that certain umbrella policies really are umbrella over your life and not just your personal life, meaning your house and your cars.
And I'll pipe in here. Just one thing to note with an S corporation, there are restrictions on ownership. So the only types of entities that can actually own an S corporation are individuals, certain trusts, and estates. So having an LLC have the direct ownership of the stock of the S corporation wouldn't be a route to go from a tax perspective. So depending on what your goals are, different structures could be put in place to give you that extra layer of protection.
Yes, thank you for catching that, Matt. I didn't appreciate. Yes, so S corps cannot be owned by other entities. The reverse is not true. In other words, LLCs can be owned by S corps, but it's the S corp that has limitations on who the owners can be.
I thought that was a great question to kind of round this thing out. First of all, before I address this, Joe, with your question about an S corp acquiring a C corp, I know you're a client, and I know that Adam is your tax strategist, and I also know he's in Greece until at the end of next week, I think. So if your question is more immediate, I mean, he's very, very good at that. But if it's more immediate, send an email specifically to me, and I'll connect you back you've got my email address. I'll connect you into Matt, and even can bring in John McCarty as well, and we can get a couple heads to address that. Michael, thanks for the question. Everybody else, thank you for the question. But Michael's question kind of leads into what we're going to do next week, which is basically talking about how do you maximize your value if you're getting ready to sell or transition your company. That's at least one of the themes, right, Jack?
Yes. Yeah. It comes up a lot. It's okay. It comes up a lot under, I shouldn't say dire circumstances, but it's like, oh, wait a minute, what am I going to do? It also can come up. So for example, I have a client who, the family business, so it's an extended family, and the aunt who owns part of the business, the children do not want to be successors of an interest of the business. So now the cousin, who is my client, is going to purchase those business assets and those business operations. So it happens in a variety of different ways, but the solutions or the possible avenues are all the same. So we're going to touch on that next week. So
here's a spoiler alert. Give yourself a 5-year runway to prepare. And I'm not kidding. That's the spoiler alert. Give yourself 5 years, and then we will walk you through some of the things that we've seen to make sure that you're maximizing the value of your business. And what will probably happen along the way too is you will start maximizing your fun along the way too, which is interesting. And then you may say, I don't want to sell the business. And I've had that happen with one of my coaching clients, and his business has quadrupled in the last 3 years because of that. So yeah, it's kind of funny.
What we tell clients who won't be offended is, we like you, but you're not sexy enough. So we're going to try to get you a little more sexy, at least, and with the bookkeeping and stuff like that. So, and it's also, you know, it's amazing to see how some businesses, the owners who started the business, they were the salesperson, very successful business, but then because someone had to be at the helm and dealing with accounting and dealing with personnel and dealing with that stuff, they got pulled out of what their core competency is. And then they've hired 2 or 3 different salespeople. And the reality is what they should have done in retrospect. I mean, it's easy to armchair quarterback sometimes, but they should have hired a manager. I mean, they're still the owner, but hire someone to be essentially the CEO or, you know, COO, CFO, and they should have been out there in the field, you know, chumming it up and making those sales, because that's what they should do. So what they've done is that they are basically paying 2 people to do what they should be doing, and in some cases paying people to do part of their management job. And, you know, so it's just a reorganization of the personnel chart to just, you know, get it right. And so, yes, it's in some cases it is that you need the additional help, and maybe not full on help bringing on somebody, but, you know, there's plenty of service providers like in the CFO arena that
Like
would
Robert
be happy.
Mayetta,
Like Robert,
Survival
would be
CFO.
Happy. Yes. And of course, and I do, Robert, personally want to thank you. You are you've become, you were probably like this from the beginning, I just don't remember, our fact checker and our color commentary behind the scenes. So just so you know, others, that every once in a while we'll get a comment from Robert, you know, agreeing with us, disagreeing, providing additional information or different information under different circumstances. So he makes us look more brilliant than we really are. So I'm just giving him some street cred and props. So.
Yeah, that's good. All right. Well, we will yeah, David does too. Yeah. So shout out to David Worrell as well. So anybody that jumped on here late, most of you guys were on pretty early, but if you jumped on late and you want to review it, and you want to review any of those slides, that's fine. We will put this thing up on the BGW CPA YouTube channel later on this afternoon, and you can always find it there. Hit us up with questions ahead of time if you want to for next week, as we're talking about maximizing value and maximizing the fun along the way too. But again, give yourself 5 years. And then what happens if you don't have that? So we'll talk about some of that too. And Matt's going to be probably mountain biking somewhere fun next week, so he won't be here. Adam's still in Greece, not in the fraternity house, but watching, you know, the Greek Isles or whatever they're doing there as a family. So it'll be me and Jack, and I may just strong arm somebody else. I may bring John in, or I may bring in Jeff. I don't know. We'll see who's around. But if in case I need to phone a friend on deep tax strategy, that's not me, but other things I'm pretty good at. So anyway, thank you so much for being here. Jack's always fun. We did miss the dad joke, but we're 3 minutes over.
Whoa.
Oh, you got, okay, go for it.
Yeah, I grabbed them off the counter. I usually, okay. So what do you call a snobby criminal going down the stairs?
A snobby, not snotty.
No, snobby or snotty, whichever. Snobby criminal going down the stairs. A condescending. It'll sink in a second. I know.
That is good.
All right. What do you call an old person with really good hearing?
Huh?
Deaf defying. All right. I got more, but yeah, it's.
Thank you, everybody. We'll see you next week.
Yes, thank you.
All right, bye.
I need to. I have the meeting still running and recording. I didn't want to turn it off until I gave you back control. So let me know what you want me to do. Just in case this is still recording. Hopefully this gets cut. It is still recording. I wonder if I hit stop. All right, Gary, whoever's responsible for cutting this needs to cut me out. I'm going to keep it running until you tell me not, or you tell me otherwise, at least for a few minutes. Hopefully it won't dump it. I'm going to go find out what emails I've missed. Hopefully I don't say anything obscene while I'm doing this. All right, I'm going to stop the recording just in case. But you have to promise to delete these last few minutes.